A clear understanding of margin is key to managing your positions and collateral effectively while trading. This video will break down the two key margin types on dYdX, cross margin and isolated margin. So let's start with the basics. What is margin? Margin refers to the collateral you deposit to open and maintain trading positions. On dYdX, this collateral is held as USDC, which is displayed as USD on the platform since it's redeemable one-to-one for US dollars. It's also important to understand how margin is closely tied to leverage. Leverage allows you to amplify your market exposure without needing the full value of your position up front. And by using margin as collateral, leverage enables you to control larger positions. And while this can amplify potential profits, it also increases the risk of loss or liquidation if the market moves against you. So how does margin work? To maintain your positions, it's crucial to meet the margin requirements set for each trade. These requirements ensure that you have enough collateral to cover potential losses and protect both your positions and the platform. Every position you open requires a certain amount of margin to meet two key requirements. The first is the initial margin, which is the minimum collateral needed to open or add to a position. This is the upfront amount required to initiate your trade. The second is the maintenance margin, which is the minimum collateral needed to keep your position open. If your equity falls below this level due to market movements, your position could be automatically liquidated to cover the loss and protect your account from further risk. It's also important to understand how these margin requirements on dYdX are calculated. The initial margin is calculated based on the position size, the market price, and the initial margin fraction for the specific market. The maintenance margin is also calculated using the position size and market price, but applies the maintenance margin fraction. To make this easier to understand, let's break this down with a practical example. Imagine you want to open a long position with a size of 1 ETH and the current market price for ETH is $4,000. The initial margin fraction for the ETH market is set at 5%, while the maintenance margin fraction is 2.5%. The initial margin requirement, i.e. the minimum amount needed to open a position, can be calculated using the formula position size times market price times initial margin fraction. So 1 ETH times $4,000 times 0.05, which equals $200. This $200 initial margin represents the minimum capital you need to provide upfront to open a position worth $4,000, with the remaining value supported by leverage provided by the platform. The maintenance margin requirement is calculated using the same formula, but uses the maintenance margin fraction instead. So 1 ETH times $4,000 times 0.025. And in this case, to open the position, you would need at least $200 in your account. And to keep the position open, your total account value must remain above $100. And if it falls below this amount, your position could be at risk of liquidation. If you want to dive deeper into how margin is calculated, check out the link below as it goes into much more detail. Now, let's take a closer look at the two margin types available on dYdX, starting with the default option, cross margin. When using cross margin, all of your positions share the same pool of collateral within your account. As you open new positions, they draw from this shared collateral, and profitable positions can offset losses from other positions. In a cross margin setup, your total equity is the sum of all positions in your account, and the collateral you hold is used across your entire portfolio to maintain these positions. This setup is typically preferred by more experienced, high-frequency traders as it allows for much faster and easier collateral management. And while it does give you more flexibility, it also means that a loss in one position can impact your other positions. To illustrate this, let's take a look at a brief example. Imagine you have two open positions. Position 1, you're long 5 ETH at $4,000. Position 2, you're long 1 Bitcoin at $50,000, making your total portfolio value $70,000. Now, let's say the price of ETH drops by 20%. The loss in your ETH position would be $4,000, and after this, your total portfolio value would drop to $66,000. Since you're using cross margin, this $4,000 loss in your ETH position reduces the collateral available for your Bitcoin position. And with less equity in your account, the margin requirements for your Bitcoin position may no longer be met, potentially putting it at risk of liquidation if you don't add more funds or adjust your positions. For lower frequency traders or traders looking for more control, isolated margin is an interesting alternative, where each position has its own dedicated collateral separate from other positions in your account. With isolated margin, you choose how much collateral you want to allocate to each individual position. This limits the risk of the position to the amount of margin posted, meaning a loss on one position won't impact the rest of your portfolio. In this setup, if the value of your collateral falls below the maintenance margin for a specific position, only that position is at risk of liquidation and your other positions will remain unaffected. So isolated margin gives you much more control over your risk, but it also means you need to monitor each position individually to ensure that you have enough collateral to maintain it. So now that both types of margin are covered, let's take a look and understand how margin is displayed on the dYdX platform. From your Portfolio tab, you can view key information about your margin usage, and this includes margin usage percentage, which shows the percentage of your collateral that is being used to support your open positions, and it helps you understand how much of your available margin is committed to active trades. Free collateral represents the amount of collateral in your account that is not tied up in any open positions, so it's essentially your available margin that can be used to open new positions or cover existing ones. Position margin shows the total amount of collateral that is currently allocated to all of your open positions. It represents the margin required to maintain your active positions and can fluctuate as market conditions change or position sizes adjust. Additionally, when you're on the trade screen, you can click through to this detailed section here where you'll see this information displayed for each specific market. Different markets have different margin requirements, so your available buying power may vary depending on which market you're trading in. So to wrap things up, here are the key takeaways on margin. Margin is the collateral you provide to open and maintain positions. On dYdX, this collateral is held as USDC and acts as a buffer to help you manage your risk. Initial margin and maintenance margin are essential. The initial margin is the minimum collateral required to open or add to a position, while the maintenance margin is the minimum required to keep a position open. Cross margin and isolated margin are the two margin types available. With cross margin, your collateral is shared across all positions in your account, whereas isolated margin lets you allocate specific amounts of collateral to each individual position. With cross margin, a loss in one position can affect your entire account. It's important to manage your risk carefully, as one position's loss can impact your ability to maintain others. Leverage allows you to control larger positions, and by using margin, you can control larger positions with a smaller amount of capital, but this increases both potential profits and risks. To start exploring cross and isolated margin, head over to dYdX.trade to get started.